Assalamu alaikum warahmatullahi wabarakatuh, and good day to everyone. I'm Dr. Zubair. I'm going to continue the lesson from what we stopped last time, which was budgeting, and now we shall look at the flexible budget and variance analysis. But at this moment, we're going to focus on the overview of flexible budget and variance analysis. So what we are going to learn from this course will be the first one to explain the concepts and importance of flexible budgeting and variance analysis. And then we will be exposing the students to how to compute and interpret variable overhead cost variances. And lastly, we're going to conclude with computing and interpreting fixed overhead cost variances. For the overview, we get to know that flexible budget is a budget prepared at different level of activities. It recognizes different cost behavior patterns and is designed to change as the volume of activity changes. A flexible budget basically has two advantages. The first one, at the planning stage, it may be helpful to know what the effects would be if the actual outcome differs from the prediction. For example, a company may budget to sell 10,000 units of its product, but may prepare flexible budgets based on sales of, say, 8,000 and 12,000 units. So something in between would be considered as flexible. This will enable contingency plans to be drawn up if necessary, because we wouldn't know whether we are going to achieve the exact 10,000 units. And is an example of sensitivity analysis. The second advantage would be actual results may be compared with the relevant activity level in the flexible budget as a control procedure. When we prepare the flexible budget, we need to also compare how is it going to be different from master budget. So master budget is basically a static as it forecasts revenues and expenses for one level of sales and production. So this will be the overview that we are going to learn when we prepare the flexible budgeting. Flexible budgeting, the first one is more of concern to effective budgetary control, which involves comparing a flexible budget based on the actual activity level with the actual results. The differences between the flexible budget figures and the actual results are called budget variances. So these are the relationships when we talk about the flexible budgeting and the variances. Let's take a look at variance analysis. Variance analysis is an analysis of the difference between planned and actual numbers. So we may have anticipated what would be the outcome of things that are yet to materialize. So we have the budget, but when we really put in place things that we have already planned for, then we call that as actual happenings. So we are going to compare what is our initial planning, called budget, and what would be the actual output, called actual. So if there is any difference between the two, we are going to call them as deviations. So it's basically things that most companies practice where only significant deviations from a budget or plan are brought to the attention of the management. Because if the difference is huge, then the top management may need to know so that remedial action can be taken. There are some uses of flexible budgeting and variance analysis. The first one, they are used for prediction. So we need to predict the levels of revenues and cost that an organization should maintain. The second is to calculate different expenditure levels for variable cost depending upon changes in actual revenue. And the last one is to serve as a performance evaluation tool to compare actual cost against standard costs for the actual level of activity. So hope you learned something from this first session of our topic. Thank you.